There is financial forwards and there is what we're calling commodity forwards. Those are two different instruments. Financial forwards relate to or analysts who invest in financial forwards try to get some form of exposure when they invest in financial assets, including stocks and bonds and the like that. But analysts who try or investors who try to get exposure through physical commodities, you're saying those are the ones now who try and identify the difference in terms of the prices of forward prices and the spot prices, and you try and get some yield from that there. So that is it about normal contango and normal backwardation there. We move on and look at the cost of carry model there. But before we go to the cost of carry model, I can probably try and emphasize a small maybe graph right over here, where we will be able to try and explain a contango situation, where we are saying if you have maybe a given level price over there like that, this is what we're saying is a spot price there. Probably today's price. That's what we're saying. Now, if you're trying to say contango, of course you expect the forward price to be represented by hard price, like that. Forward price is greater than the spot price. That is what we've demonstrated right over here. And this is very significant. Graphs also need to also be complete, because we are saying that here we need to plot the yields over here against maturity, like that. And then over here we have the prices. Like that. I'm just trying to relate it with what you've written over here, like that. What we've written over here, forward price is greater than the spot price. Right over here, you can see this is what you're saying. This is a spot price being greater, like that. Of course, the opposite will hold for backwardation. So here I can be able to say this is contango. That now on this other side, I can be able to draw a graph that shows us how the backwardation scenario looks like. So here we have maturity, and here we have the price here. So here we have the spot prices existing like that, and now scenario like that, spot price, and this is the forward price like that. So this we're saying is backwardation. That. Now, having looked at this, it would be good for us now to move on and look at the cost of carry model. We are still building on what we've actually learned, the term structure of forward prices and the concept of contango and backwardation, which analysts try to seek, whether they're investing in financial forwards or commodity forwards or physical commodities themselves. That's what we're saying. We'll be building on that. And having looked at that, let's look at the cost of carry model. Yeah. Now we need to mention something over here. We can say this is a measure of the financial difference between holding a position holding a position difference between holding a position, I can say, in the spot market, in the spot market, like that, and holding, move on this other side here, holding a position in the forward market it and involves in the forward market you can say it involves two strategies with identical economic results. That, but different prices, that reflect the cost of carrying cost of carry economic strategy. Like that. So the relationship, you can say the cost of carry relationship is as follows, where we can have, if you recall in our previous lesson we had said that the forward FT, the forward price, is equals to S for all maturities. Like that. That is when we are looking at the term structure of forward prices, like that. Now we are building on this in our previous lesson. We'll be building on this by looking at now a different model, which is of the form FT, like that, is given as the spot prices plus the carrying costs. This is more so for commodity forwards, not financial forwards, for commodity forwards, because we are saying the cost of carrying the asset is what is going to be considered right over here. Now, having looked at the cost of carry model, now we will build on this so that we can look at different scenarios where we can be able to try as much as possible to look at the forward prices and arbitrage. Arbitrage represents a scenario where a security or an asset has been issued in two different, the same asset has been issued in two different countries, for example. Maybe in one country it is much cheaper than the other country. It means that the difference in pricing, individuals can be able to leverage or earn riskless arbitrage profit by investing in the one that is cheaper and then selling it at a higher price, like that. So probably I'll be able to demonstrate that shortly. So let's look at the forward prices and arbitrage, like what we have said over here. This is what you're going to look at now. Forward prices and arbitrage. Now, if this is, just for example, this is Kenya, this is Uganda. Suppose a bond, just let me use the example of a bond. Yes, I know we are dealing with commodities, but for purposes of simplicity, let me use a bond. Suppose a bond has been floated here in Kenya and it is priced at, say, 1,000. That. The same bond, if you convert Kenya shillings, this is shillings. Suppose the same bond has been floated in Uganda at the same price. But now, converted into Kenya shillings, it's probably maybe at 950. If you convert it into Kenya shillings, it's the equivalent of that. It is the same bond, but has been floated in different countries at the same time. What happens is that the analysts or the investors in Kenya, if they realize that there's an opportunity that exists in the financial market or with the bond, what they can do is that they can be able to invest in the bond the cheaper security. Yes, it is the same security, but the cheaper security which costs 950. So that now they can now sell it at now 1,000 when the prices are actually increased. Remember, if there are too few goods that exist like that, as compared to the population over here where there are so many individuals who want to demand, say for example, the very few, the little tomatoes that have actually been grown in an economy, what happens is that since there is so much demand for these products over here like that, what happens is that if it was initially one tomato was going for 20 shillings, now because of that demand, it will increase the prices to probably maybe 40 shillings like that. That is the same principle over here. Capital flows will go into Uganda to purchase or to procure to purchase that bond, and that will cause the prices to start moving up like that. Once it moves up like that, it will be able to settle off at the initial 1,000 shillings price over there, because we are saying we expect an equilibrium price to actually exist there. So that is what we are saying is arbitrage. So those individuals who bought the bond at 950, they will probably now decide to sell it at 1,000 shillings, earning a riskless profit of how much? So it's 1,000 that you're selling it at minus 950. They will make a clean 50 shillings profit like that. This is just a hypothetical example like that, but in the market, this is exactly what happens. Investors tend to earn riskless profit of this form like that. It's the same instrument, but you earn riskless profit by just taking advantage of price differentials if the instrument is floated in different countries like that. So we can say that for an underlying asset, there that does not pay any income, that the forward price is as follows. That where we have the F, now we are building on this. Please note, guys, that this is what we're trying to build on. T, like that. But now we include is equals to the spot price, it's almost similar to that, multiplied by the transcendental factor, E, like that, and then power R T, put T capital, R T, where we start with FT. We had already explained what FT is. Price, the forward price there. Then we have S, spot price. E, transcendental value. That represents continuous compounding. R, risk-free rate, cost of interest, and T represents the time like that. Now, the best way to demonstrate these forward prices and arbitrage is by looking at an example. So let's look at an example that will incorporate that there. The spot price of gold is currently at 700 shillings per ounce. The current continuously compounded interest rate is 4%. Compute the price of a 6-month forward contract on gold. So we are trying to determine the forward price. And the forward price, E can be gotten using this formula. Here you have the spot price, the transcendental value. There on your calculator you have that E, and then R is the required risk-free rate. And the risk-free rate in this case is continuously compounded. You've been told is 4%, and then you're told that the time factor is 6 months. And you know 6 months out of 12 months is what you're saying we will be able to use. 6 out of 12, because in a year we have got 12 months there. So putting it all together, we have solution. So solution, we say FT is given as, what is the spot rate? The spot rate I can see here given to us is 700. E, which you're saying is a transcendental value, the continuously compounded value. Then R, the rate we're saying is 0.04, and then times 6 over 12. Why 6 over 12? Is because we're trying to get 6, the proportion, 6 out of 12 months there. So now putting it all together, how much do we get? We first of all work out the transcendental value there. So we're saying shift E1. We want to first of all get what the value, the transcendental value is. This transcendental value I can see is 2.71828. Please check from your calculator there where you will see an exponential or the transcendental value there. I get 2.71828, and then that you now raise it to power that there. So power, it's 0.04 multiplied by 0.5. This 6 over 12 is the same as 0.5. Like that, I get 1.020. So it's 700 multiplied by 1.020, like that. So that you multiply by 700, we have 714.14. 714.14, like that. That is the futures price, or the forward price rather. This being the spot price, we expect that the forward price will be 714.14. How many months ahead? 6 months ahead. So 6 months ahead, we expect the price to move from 700 to 714.14, like that. So that is an example of how we can be able to calculate the forward price for an asset that pays no component of income, like that. That is it. Over here, we are done with the forward prices and arbitrage, like that. Now we try and twist it a bit. We try and delve a bit deep, and we will delve a bit deep now, building on all of these concepts over here by looking at arbitrage-free pricing and financial forwards. Then we'll move ahead by looking at arbitrage-free pricing and physical forwards. How do we determine the forward prices when we are dealing with financial forwards? I already said that financial forwards represent assets that are inclined towards or seeking exposure towards indices or fixed income instruments or based on, say, for example, the US Treasuries, like that. That is what you're saying is financial forwards, financial assets there. Physical forwards, now you're dealing with, say, barley, wheat, physical commodities themselves. Now, the pricing over here will be very different. So we are going to look at it on this side. So we can say arbitrage, free pricing, and financial forwards. We can say financial or financed positions. You can say financed positions allow